This is the monetary policy statement for June 2017. The annual headline inflation, as measured by the change in CPI, increased by 7.2% in May 2017 from 6.8% in April 2017. This was largely driven by a sharp increase in food crops prices and higher energy prices. Food crops inflation rose to 23.1% from 21.6% in April 2017, largely on account of the impact of adverse weather conditions on food crop production. Energy, fuel, and utilities (EFU) inflation also rose 7% from 5.3% over the same period. Annual core inflation, however, remained relatively stable. Increasing only marginally to 5.1% in May 2017 from 4.9% in April 2017. The relative stability of the exchange rate and subdued domestic demand have contributed to the dampening of core inflationary pressures over the last 12 months. The economy has continued to grow at a moderate pace. According to the latest gross domestic product estimates released by the Bureau of Statistics, UBOS, the economy is estimated to grow at 3.9% in the financial year 2016-2017, compared to a growth rate of 4.7% in the financial year before. The slowdown is mainly due to the drought that affected agricultural production, coupled with slow implementation of public projects, public investment projects, and weak private sector credit growth. Economic growth is projected to pick up to 5%, yes, 5% in financial year 2017-2018, supported by improved efficiency and effectiveness in implementation of public investments, higher foreign direct investments, particularly in the oil sector, and recovery in private sector growth as lending interest rates continue to decline. Indeed, monetary conditions have been easing with average lending rates declining 20.5% in April 2017 from a peak of 25.2% in February 2016, a cumulative decline of 4.7 percentage points. Growth in the agricultural sector is projected to increase as normal weather conditions return. the Bank of Uganda's forecast for inflation have not changed substantially since the previous Monetary Policy Committee meeting 2 months ago. The supply side shock that caused inflation to edge up in the last 6 months is temporary and is expected to wane in the first quarter of 2017-2018 financial year. Moderation of food prices is expected over the medium term. In addition, the favorable inflation outlook is driven by downward revisions to international oil prices, which is expected to lower EFU inflation rates. In line with the previous forecast, therefore, inflation is forecast to stabilize around the 5% target in the next 12 months. With the domestic inflationary pressures remaining subdued and given the continued weak prospects for economic growth, the Bank of Uganda judges that continued easing of monetary policy is appropriate. This will be consistent with achieving the core inflation target of 5% over the medium term, and will also support the recovery of real output in the economy. Accordingly, the Bank of Uganda will reduce the central bank rate by 1 percentage point to 10% immediately. The band on the CBR will be maintained at plus or minus 3 percentage points on the CBR, and the margin on the rediscount rate will be maintained at 4 percentage points on the CBR. Consequently, the rediscount rate and the bank rate have been reduced 14% and 15% respectively. Here ends the monetary policy statement for June 20.